Hi, my name is Joe Park. I'm CEO of Horizons Stewardship, and I am thrilled to offer this webinar for you today, a first look at applying for PPP loan forgiveness. Joining me today is Stan Reiff. He's a partner at CapinCrouse. He's a practice lead and a frequent webinar presenter here with Horizons. You are going to love today's webinar. It is full of technical information. We've got an abundance of additional resources to provide to you that will help you as you begin to fill out your loan application so that you might maximize the forgiveness. Stan, I want to welcome you with us today.
Joe, thank you again for the opportunity to join you on this webinar with some of this late breaking news that just came in. Good news is we've learned a lot this weekend with the latest information that we received from the SBA Friday evening. And so with that, we want to cover some of the baseline information very, very quickly and get to the new information. But let me just go ahead and say really quickly, the reality is we now have answers to the pay periods that will be covered. And we also have some other clarity on some of the FTE calculations. And so we'll cover that. And certainly I'll go ahead and hand it out, right here. I've actually printed out a copy of that loan application. It's 11 pages long, but don't let that scare you. It really is only, the application itself is really only 2 pages. So let me go back actually and talk a little bit about the loan forgiveness overview that we're going to cover today, which is that second, third slide there, Jeff. You'll go back a slide or two. So we're going to cover the application today. And with that, we want to make sure you're aware that you will be filing your application for loan forgiveness with a bank that is servicing your loan. It may be the same bank that you did your loan through, but it is possible that it may have been forwarded or that loan may have been sold, merged to another bank. That being said, even though the bank will be processing that loan, SBA or the loan forgiveness application, it will actually be the SBA who will review and award that, that forgiveness. And then certainly there'll be more guidance coming, but they committed that they will approve those forgiveness applications within a 60-day window. So just as basics, again, as we walk through this, there's really 4 qualifying expenses. The payroll costs we've been talking about, we'll talk about more today. The mortgage interest, the rent, and the utilities are the 4 key points in the area around the expenses that are both allowable and potentially forgivable. Again, just as we kind of glance through this to get to the new information, what we do know is, again, just as a reinforcement to previous webinars and to the content that's already out there, that as a reminder, the employer's portion of FICA or the Medicare or FUTA are not eligible for reimbursement or the forgiveness. Certainly, again, just any compensation over $100,000 annually has to be limited at the $100,000, and specifically over that 8-week period, that number has been identified by the SBA to be specifically $15,385 is the maximum amount that can be forgiven per employee if they're at the $100,000 or greater amount. Some confusion, and Joe and I continue to get a lot of questions around some of these topics, that independent contractors are not eligible. Let me restate that. Independent contractors are not eligible to be included in the payroll forgiveness application. That's just not part of the independent contractors are eligible to apply for their own PPP, but employers cannot include independent contractors. So if you have worship leaders,
independent contractors would be someone paid on a 1099.
That's correct. So you may have worship leaders that you're paying on a 1099, et cetera. They would not be eligible to be included in your payroll calculations. They would need to have their own PPP loan. Again, also for those who may have employees living abroad, I'm thinking of some churches who have missionaries who are living outside the U.S., that they are not eligible for this loan forgiveness. One other piece that we've been talking about consistently, but just want to reinforce, is again, any wages that have already received credit from the Families First Corona Response Act, and specifically the Expanded Family Medical Leave Act or the emergency paid sick leave acts, all those are already accounted for in other payroll tax deductions or reductions credits. So those portions are not eligible.
So Stan, is that the general rule if it's been covered under another program? I think the CARES rule had some money that maybe some of our licensed daycares have been receiving. If they've used those to cover salaries, you can't deduct those from the PPP loan program. Or
That's correct, Joe.
Can't
That
double
is
dip.
correct. Correct. So then one other item that keeps surfacing with some regularity in my inbox is, we weren't able to include our ministerial housing allowance or clergy compensation. The reality is even if you weren't able to include it in your loan application, the SBA has certainly deemed that it is allowable and it is forgivable. So clergy compensation and specifically clergy housing allowances are both allowable and forgivable in this process.
And just to answer a question I've gotten a number of times, if you did not have that included in your PPP loan application at the beginning because your lender wouldn't allow you, there's not a process to go back and add it. It is forgivable, but you can't go back and ask for more money.
That's correct. So in many ways, though, we're finding is those who weren't allowed to include it at the beginning by their bank, in some ways, it's actually a blessing on the tail end of this, because now you can actually include that to make sure you're maximizing the forgiveness portion. So we're going to see here pretty soon that it's becoming a little bit more difficult to get 100% of that loan forgiven, and we'll work through some of those mechanics here shortly. Again, there's been some questions that we've answered in the past, Joe, that we've got some clarity on. Certainly certain bonuses, merit increases, pay raises due to promotions, and hazard pay may be forgivable, but we don't know yet. The SBA has not ruled on that specifically, but here's what we do have as a guiding principle, and that is that it's unlikely that expenses that are created solely for the purpose of loan forgiveness will meet that criteria for forgiveness. So we would say, certainly if it was if as an organization, you always do your employee evaluations in April, you do your merit increases or cost of living increases consistently year over year in May, that's if on the period that could be justified, and the rationale would need to be included and documented, and there is a good chance that it would be included. But if you're just increasing pay and creating bonuses for people to maximize the loan, those will probably be disallowed. We're not sure about hazard pay yet, but we believe that there's justification and a reasonable approach that we would encourage you to count all that and monitor that, and it could be forgiven, it may be disallowed, but at least if you're doing it and you're keeping records and justification for it, you'll increase the probability and the odds of that being forgiven as well.
I get a lot of questions about that, Stan. So let me repeat this back and make sure that I'm understanding it. So raises, overtime, hazard pay, that would happen in the normal course of your business are likely to be included. There's not clarity, but right now you're recommending your clients to include them, include the justification for it. The caveat is if the maneuver is purely to increase payout just for PPP loan forgiveness, that in and of itself would be excluded.
That's a great summary, Joe. Well said. Again, there's a few items that we don't have clarity on, which would be the next slide, Joe. And my guess is these really do not apply to most of the audience, churches, and many people may not even recognize the acronyms here, if you will. But we don't have guidance from the SBA yet, and it certainly applies to several of our clients and those in not-for-profit settings that would be larger. But so let me just go over these quickly as we move on. Qualified small employer health reimbursement arrangements, the individual coverage health reimbursement arrangements, the accepted benefit health reimbursement arrangements, and then health savings accounts with high deductible health plans. None of those have been addressed by the SBA yet, but again, those are not center fairway. Most people on the audience won't have any of those issues, but if you happen to be with a a denominational agency, or if you're with maybe a higher education institution, or you have any of these, we want to make sure we communicate to you that there is no guidance yet from the SBA on those, but those are certainly a little bit more obscure and more detailed. Again, we also don't have guidance on self-insured group health insurance plans. We know they will be allowable. We're just not sure how to compute those from a covered period and the various factors when you've got long tail expenses that are coming in after the period. So moving on to the next item, and so this kind of covers right now just reinforcing what we've already talked about and the guidance we do have, and moving into the next area about the non-payroll.
Stan, let me ask before
yes.
we do that about the prepaid premiums.
Mm-hmm.
Will likely not be forgivable. A lot of question about expenses incurred and paid. Could we just stop here and talk about the for monthly recurring expenses? What period do you include?
So if you don't mind, Joe, let me take that question and move it back a few more minutes. And we're going to actually go very, very deep into what that looks like when we cover specifically payroll and benefits, in identifying. We'll actually have a couple of examples we'll walk through to bring some clarity around the computation, how to really analyze that. The SBA has really done a good job for now in identifying what that looks like and answering those questions. So we'll come to some of those slides.
I think you probably made a lot of people breathe a sigh of relief here, because that's a struggle folks have been having.
Yeah, so that particular bullet point there, Joe, talking about prepayment of premiums would be, for example, if you're paying in advance for a whole year on some type of insurance premiums, those probably would not be allowable because they're not specifically incurred and paid during the period. They're covering a whole year as a prepayment.
But you could include the 56 days in the period.
Right now, the guidance is it would not be, because even though it's incurred, you're not paying it during that time. And again, we're going back to a cash basis, not the accrual basis.
Okay.
Okay. So let's see, I'm looking at slide 12 in my notes right here, Joe. So I want to talk a little bit about the mortgage interest. There we go. Thank you. So here specifically, one of the things that we want to make sure we're highlighting, we're not sure there's always been great clarity and discriminating emphasis, if you will, that when we talk about your mortgage being forgivable, only the interest portion is forgivable, not the principal payments. And again, no prepayments on interest or prepayments of principal are allowed. Only the actual interest expense for the covered periods, and we'll cover that again shortly. The other thing we were curious about that we were asking, certainly loans on other equipment, intangible personal property, like church buses, if you will, ministry vehicles, and office equipment, where that equipment is securing that loan. The interest on those loan payments is also forgivable. So I think that's an important part. One last piece would be for any church that's in a construction project, as long as you had a construction loan in place before February 15, and that's a very, very specific date administratively in the application process. If you already had an existing loan, or any of these loans existed prior to February 15, and you have the active construction going on, then even construction loans are, the interest on those are forgivable. On the rent, again, your lease agreement had to be in place before February 15. You can't go out and lease a brand new place starting in April. So it has to be predated. And then it can be for both real property as well as personal property / equipment. And there's examples there. Utilities, we've continued to get a lot of questions around that. So I think this slide really highlights that the forgiveness portion includes, and again, when you actually get to the application, we'll cover that shortly. The utility, the payment expenses, if you will, can include electricity, water, sewer, gas. We don't know specifically about transportation yet. And telephones, certainly if it's in the church's name, if those contracts are. What we don't know yet is if you have a bring your own device policy as a ministry, i.e. you have your own cell phone contracts and you have your own internet at home, if those will be includable for forgiveness. But again, we're recommending as a best practice, go ahead and be tracking all that, documenting what's in the contract name of the church or ministry versus what's in the name of the employees. And then certainly by the time the application is due, we hope to have the final pieces of information. We actually, again, recommend that you do track all this, even if it may not be forgivable, but it's better to have the information and be ready to submit it and then have it declined than to not submit it at all and forfeit the opportunity of potentially having an additional amount of your loan forgiven.
So that's going to be a good rule of thumb with these in these areas that have yet to be defined. Track that. If you can spend it on something that is already known, great. If you're not able to do that, having these available to potentially include in your application will increase the probability of a higher level of forgiveness.
Absolutely. So, and again, just really briefly, even though sewer payments specifically have not been included and named, called out specifically, most utilities include your water and sewer bill together from the same municipality or utility company. And so that's there. Interesting enough, we don't have final authoritative guidance on the actual trash collection, if that will be includable or not. But again, as a best practice, we're recommending that you do track that and have it ready to submit. Let's talk a little bit about the application that's actually come out. Again, as I was mentioning earlier, I actually printed out my copy, I've been studying it. It's 11 pages long, but 9 pages are really more instructions and definitions. The actual application currently is 2 pages or 1 page front and back. And has been mentioned in some discussions, most likely the banks will actually take these applications from the SBA and will most likely, many of them will convert to their own electronic application process. The information will be substantively the same. The questions will be substantively the same. The formatting and the branding may change by bank. We would not be surprised if the smaller banks just use the SBA application, but we do anticipate many of the larger banks will modify and create their own. There's really 4 key areas involved or sections in this application. And for practical purposes for churches and ministries, only the first 3 are relevant. So if you look at the slide in front of you, that borrower's demographic form will not be applicable to most ministries and churches. So you're really only focusing on the core form itself, which is that 1 page front and back that we've talked about. The Schedule A that will need to be submitted along with it, and that's where all your calculations will go, and we'll walk through that. And then certainly there's some additional information that will be available at the end of this webinar that we have a 15-page handout that goes with this. But you'll actually compute all those that information, and then you'll need to keep the supporting documentation handy. And it's not required to be submitted, but certainly, again, a best practice would be to submit your work papers with the calculations and those schedules. Not all of that will be needed, but we'll talk through some of that as well. We've already talked about the fact that the lender who's servicing your loan, most likely the same as who granted you the loan, will be doing the application for you, but SBA will be doing that loan forgiveness amount. Moving on to the next period. Now is where we're really starting to get into the nuts and bolts of what we're talking about. If you'll recall from previous webinars, we've talked about, what does this period look like to maximize the loan forgiveness of your payroll. So 2 things I want to really highlight, Joe, is we have many organizations, a lot of the questions we've been getting talk about 2 months as being synonymous with 8 weeks. And here's where we start getting really technical and specific. The SBA is literally and specifically talking about 8 weeks or 56 days. If you actually look at most calendars, 2 months would be 60 to 61 and potentially 62 days, depending on when you get your loan. If you have July and August as a period, that would be 62 days versus the 56. So generally speaking, for the time frame we're looking at, 2 months would be somewhere between 61 days, or most likely 61 days for most everyone. But we are very, very specifically, the SBA is talking about literally a 56 days, 8 weeks. So now there's some we're aware of as we work professionally with other tax attorneys and whatnot, that some are still thinking there may be some provision that will come down later that will broaden it to include the 2 months versus 8 weeks and 56 days. But our position currently is it's been very clear that it's 8 weeks, 56 days. So we want to talk about that, because certainly if by the application, and I'll reference it here real quick as we're walking through, specifically, you'll end up including your lender PPP loan number, the loan amount, the number of employees at the time of the application. You'll enter the employees at the time of the forgiveness. So this is the total, again, Social Security numbers, or the number of hearts that are beating. That will be comparison there. But then they'll also be wanting to know the loan disbursement date. That becomes the date that the 56 days start calculating. And then from there, so for example, the illustration that we use as a case study in our documentation, on the first pay period, or the first payroll within what we are now calling the covered period, is what the SBA is talking about. That first payroll, you would need to adjust so that only the payments that are reflected of the days the employees worked from the day that the funds were received. So if we say the funds were received by your church or your ministry on April 20th, then when you do your next biweekly payroll or your next end of month payroll, then only the dates from the 20th on would be included in the forgiveness calculations. On the tail end of those 56 days, let's say June 14th is that last day, then, and you would count that, then you would count those days, and even though they aren't getting paid until after June 14th at the end of your 56 days, it would still be considered earned and paid as long as they're paid in the next normal or naturally reoccurring payroll cycle. So before we talked about, hey, do I need to go ahead and make payroll 3 days before we normally would to get within that 56-day window? You don't have to do that. They've simplified it by saying, if you normally pay every other Friday, then we will work with that. And if they had days that they had worked up through that 56th day, and as long as you pay them in the next regular Friday payroll, then they will be considered earned and paid in that cycle. Now, conversely, the SBA has created an alternative covered period where they'll say, okay, we'll cover the first pay period within the dates and we'll extend the 50 days from that. So you don't have to cut up and reanalyze those pay periods. And so certainly they want to make sure everybody's covered, and the forgiveness is there for the 56 days. And they give you different ways to measure that to keep it simple. And again, certainly your payroll companies will help you do those calculations and break it down by day.
So Stan, what I'm understanding in this is that the incurred and paid may not be exactly literal as we've been interpreting that the SBA is essentially saying if you're going to take the literal days, you'll start with the day that your application was filled in, and you will run it back 56 days, regardless of how you actually paid them. That's the way you'll count it. Alternatively, if you are using one of the alternative pay cycles, that you can use the basically 56 days of your pay cycles, which still may create a little bit of a challenge for people that are paying twice a month, because they're not going to get actually 2 full pay cycles. They're only going to get 56 days worth in there.
That's correct. But certainly, again, they're going to make sure everybody gets the 56 days of pay forgiven, as long as you're making those payments during the regularly cycled, normal cycles of payroll. So you don't have to change your payroll cycles to accommodate the 56 days.
Which is the huge bit of relief we were looking for. Those of us that were on a twice a month pay cycle were hoping we would get those extra days. SBA isn't allowing those, but we don't have to change our pay cycles. It's really just how we fill it out in the application, which is a great relief for I think most of our listeners. And in the handout that people will be receiving, the article written by Ted, it essentially gives two examples, an example of how to calculate the front end and the back end, or you just, the third alternative is use your current pay cycles, count 56 days in that window, and you're good to go. All right. Well, that's big. That's huge.
That's really big. But let me also pause, because now we're starting to get into some very technical nuances. This covered period for payroll and the alternative or the alternate covered period only applies to payroll costs. The alternate payroll period does not apply for non-payroll costs. Does that make sense?
It does. So now we're talking about the, the rent, the interest expense, and that sort of things. But in regard to health insurance and other related expenses, those 56 days, and we're going to have to calculate what 56 days of health insurance is going to look like compared to 2 months worth, right?
That's correct.
Okay.
Now that being said, again, because that's our current understanding, but again, typically premiums are paid on a monthly basis and are attributed that way regardless of the 24 or 26 pay periods. And so those allocations get funded a little bit differently. So from the employee contribution to it, employers are still just paying that once a month. So that's where you might actually be able to take those monthly premiums and factor it out that direction. We don't have the actual specific guidance on that piece yet, but most likely it will be the 2 months of premiums when it relates to the actual employer's cost for the payroll. I'm sorry, for the health benefits, etc.
Okay, so everybody taking a deep breath here. We back to slide 2 and Stan's presentation. We know a lot of stuff. Some things we don't yet know. What I do want to assure you is Horizons has an agreement with CapinCrouse. As that additional information flows forward, if you are signed up to receive our content, we are going to continue to update and share with you that information as it becomes available, because there still is a lot we don't yet have definition on. All right, Stan.
So if we
lead
move
us on.
Yeah. So if we move on to the next slide, and I might want to go a couple. So we've already talked about these again. So again, the borrowers receives the funding on April 20th, the first day. Actually, if we go back to that previous slide, yeah. So that first day, the borrower's first pay period following the PPP loan is that Sunday, April 26th. That basically is the case study illustration. Gives you that. In summary, what I was just talking about as an illustration. If we go on to the next slide, is really what I would like to, a couple of the points I want to highlight. Payroll costs are considered incurred on the day that the employee's pay is earned. So that's literally on every day that they're working, including a sick leave or vacation leave or other personal leave. That's when it's incurred. The next sub-bullet point, payroll costs incurred but not paid during the borrower's last pay period of the covered period are eligible for forgiveness if they are indeed paid on or before the next regular payroll date. And this is where you'll fill out the schedules we'll talk about, and you'll want to have the supporting documentation that shows that the money came out of the bank. You'll want the documentation from your payroll company showing that indeed the pay that was earned but wasn't paid till after the 56 days because of the regularly scheduled payroll date. That will then be the supporting documentation required to say They earned it, and we paid it in the next regular business cycle of payroll. Again, let me go on to the next, and we've kind of covered this really, and I'll go through it one more time. But again, this, I guess, Joe, is this deck of slides will be available for everybody to go back and look at.
Absolutely. The slides will be, when you download this, the slides will be right there with it. The Q&A will probably be brought out separately.
Okay.
So you would need to download the recording of the webinar, the Q&A, and the slide deck, as well as a handout that the slide deck is created from.
Okay, so again, we talked about the covered period begins on April 20th. That's when you receive the funds. You're on a bi-weekly pay period, so the end date is Saturday, April 25th. Then the pay earned on the period of 5 days from the day you receive the funds till the next payroll is includable in your calculations for the covered period for forgiveness. That's on the front end. And certainly the next, 50-some days, if you will, the full amount is incurred and paid within that 8-week period. And then we start getting here that, again, the same, where that pay period ends on June 14. The next bi-weekly pay period after the June 14th is June 20th. The pay earned between June 6th and the 14th is includable as long as you actually do pay it on June 20th. So that's talking about the front end and the back end, that even though you didn't actually pay for those last few days, as long as you pay it the regularly scheduled payroll that follows that period, it is includable. Bottom line, and I'll keep emphasizing this, we're not talking about 2 months or the 61 days. It's literally 8 weeks, 56 days. And so again, the article we talked about has some additional examples where it breaks it down differently. So you have multiple ways to look at that, including the alternative covered pay periods. I want to highlight again, the non-payroll costs incurred during the covered period but paid on the first regular billing date after the covered period are included. So that would be specific things such as, depending on when you received your loan funds, if you had some other things such as you received, let's say, your funds on the 3rd of a month in your, and so the end would be, let's call it on the 2nd of the month at the end of your 56 days, maybe it's a better illustration, and something's due on the following day, but you've already incurred the all that expense. That next day concept for making the payment is allowable. On the next slide, just want to talk a little bit about, now we want to get into some of the practical pieces of this loan application that we have. And we start talking about that 75% payroll cost rule. So let me walk through this. And again, some of this it becomes very, very clear in the application process. And again, there's links to this in the documentation. It'll be on the website that Joe has with Horizon. But let me just walk through this. The first interim final rule requires that at least 75% of your PPP loan proceeds have to be used for payroll costs. That's payroll and benefits. Forgiveness will be denied only to the extent that it isn't the case. So in this case, I would say, let's assume you borrowed, or your PPP loan was for $100,000, but you only spent $70,000 on payroll costs. So 70% is 75% of what number? So again, you see the calculation there, that it would be $93,333.33. So assuming that your mortgage interest, rent, utility payments, and all your other non-payroll allowable costs was a max of $23,333.33, then you would be able to, the max amount you'd be able to get forgiveness on is that $93,333, and you would be required to return the $6,666. That's how that works. Now that's assuming, which is a kind of a segue to the next section we want to talk about, where assuming there's no salary or wage reductions and FTE reductions that offset that. These are also calculations that will require schedules and spreadsheets and calculations you'll go through. So what are we talking about? So there's several key points in the salary wage reduction that we want to look at. The calculation looks at whether it's been an amount greater than 25% in the change in the employee's annual salary or hourly wage during this covered period. So for example, and we'll go through some of these examples really quickly. So an exclusion would be if someone makes more than $100,000 a year, certainly that's already capped at that, and so they're excluded from the calculation. But we'll want to look at some of the others, and so the next slide we'll start talking about how we do that. So here's a sample, an example, a case study, if you will. Prior years, and would be that the column just to the left of the last column with the red circles. Normally, John makes $77,000 a year, but the amount that he's actually earning during this covered period is $55,000 because we've done a wage reduction for this period of crisis. In that particular case, John has experienced a 28% reduction in his pay. So that's going to be an offset. However, Sue normally makes $90,000 a year, and her reduction to $85,000 annualized for the period is only 5.5%. That will not impact the calculation. So what they're trying to do is make sure everybody's being maintained as whole as possible. So they're allowing up to a 25% reduction in pay, but anything greater than that ends up being a deduction or a reduction of the payroll calculation for the forgiveness portion. Let's go on to the next slide. So again, here's how we would look at that. So again, John, we'll look at John as the example. His average compensation for the prior quarter on an annualized basis is that $77,000 we talked about. 75% prior to that calendar would be the $57,750, but the average rate was $55,000. So there is that row D shows up at $2,750, and so that becomes a portion that then gets offset, as you can see the calculations there in rows E, F, G, and H. And so you can see the same for Mary as the other person who had a reduction. And then you can see how those totals end up being added together. And so row H, where you multiply the amount on row G by 8 for the 8 weeks, gets you that calculation for an hourly employee. On the next slide, so that talks about some of the wage reduction. And again, the white paper that comes with this goes through some examples as well to further clarify, so we can get to some Q&A here in a few minutes. I want to pivot to the full-time equivalents. So now let me talk again, because early on, we fully are aware that in the application process, we talked about how many unique employees do you have. As you hear me talk about how many Social Security numbers are employed. And then we certainly knew that they were going to be analyzed against full-time equivalents. So it's going to be both. On the application, on the face of the application, we'll say, how many unique employees did you have at the beginning? And how many do you have unique at the end, or at June 30 specifically? They want to look at that number as a comparison, but then there will be further calculations around FTEs, and there's actually the 5 calculations that you'll be doing this FTE calculation for. One will be at the beginning and before, prior year, an alternate mechanism, and then the FTE at the end and at June 30. So let's talk about what does that look like. There's actually 2 methods of calculating your full-time equivalent, and you get the option of picking the one that best benefits or most benefits you as an organization, or another way to say that is provides the least penalty to you if there is one. And so it's we actually in the white paper do 2 different case studies that show the difference in how one ends up with a forgiveness reduction, and the other one, by calculating it differently, remains neutral and there is no penalty or there is no reduction in the loan forgiveness. So in this particular case, the forgiveness application, if you use these instructions, each employee, you determine the number of hours paid each week. So, and if it's more than 40, you limit it to 40. So nobody can have more than 40 hours for this calculation. Then you take the average hours that's paid per week. So you're looking at number of hours for each of the 8 weeks that we're looking at. You determine what the average is, and then you divide that by 40 and you round up to the nearest tenth. Again, the result cannot be greater than 1. So if somebody's working 50 hours a week, you end up with something greater than 1. That is discounted to 1. You can't have a number greater than 1 for this calculation. Then we go on to the next piece. The instructions provide for a simplified model. Either somebody works full-time or they don't. You're either full-time, you get a 1, and if you work less than 40 hours, you get 0.5, the equivalent of a half-time position. So where this may help and it may not, depending on the stability of your workforce, the number of people changing, the number of hours they're working, the variableness during that period, both before as well as during this period. And so again, based on your own calculations and your own normal rhythm as an organization, that makes a difference. Now, we'll also say, here's a classic example where we don't have enough information yet for preschools, for K-12 education. My guess is even camps where you have a lot of seasonal employments. That's a regular occurring business model. We all expect schools to close at the end of summer. Preschools have been impacted greatly because of, again, of the COVID and the way they have to staff appropriately at the preschool level. And certainly as we're ramping up for summer camping, right now would be a low season and we'd be normally hiring up and we may be delaying that by a month. Those changes, there will be guidance coming and there will be some relief granted to organizations in these categories. If we can go on, I'd like to talk again a little bit about what this looks like. So again, you can start seeing some of these tables of what that looks like in a case study. So if you take the one approach where you've got, for example, you're doing the computations we've talked about. So each week you put the number of hours everybody's working and you see the stability there. For example, that Bill, about 2/3 of the way down that table, has consistently always works 25 hours a week and he gets a 0.6 rating. In contrast to Steve, who has a little bit of variableness in the number of hours as an hourly employee, and his ends up at 0.4. But at the end of the day, there's still a 6.0 number of total FTEs, even though there's 7 unique individuals, the FTE ends up being an equivalent of 6. So that's the one example. Now, if we work on to the next computing, then you can see the covered period, the reference period, all those pieces play out into these FTE calculations. So these are the factors there. Here's where it starts getting interesting again. So as we talk about what does that reduction quotient look like, they're really looking for the total number of head count and doing that as a comparison of data points between total unique individuals, the reduction in wages, and then the possible skewing of those numbers through reducing people's amount of time to work. So you might have kept your head count up, but they're working fewer hours. They're trying to look for all those kind of indicators to maximize what the intent was of this act, was the Payroll Protection Act. So if you look at this, the FTE reduction quotient, you'll look at the FTEs during the covered period against the FTEs during the reference period. And that reference period has multiple options to pick from as well. So the fraction is multiplied times the total forgivable cost to arrive at the loan forgiveness amount. Again, we're getting really technical here. Don't expect everybody to memorize this and be experts yet. But again, you'll have the deck of slides, you'll have the white paper that will go through this in greater detail to help you walk through those calculations. Again, we want you to breathe easy, that you don't have to have it all right now. It will be available for later. But this will start getting you used to the calculations and creating the schedules that you'll need to document the forgiveness portion that we've been talking about for the last few weeks. So the permissible reference periods that you can pick from would be June 15, 2019 through June 30, 2019. So you can look at that from a year ago, or you can look at roughly the 2 months or the 8 weeks of this year starting January and February. So you can run those calculations, and that becomes part of your calculation against the FTEs of your covered period, which is that top calculation in the quotient.
And I'm assuming you can't mix and match and use the simplified to calculate your current and the traditional model to calculate what you were before.
Great question, and you are correct. Pick a model, and then you have to consistently apply that through the calculation. And so that's where ultimately you might end up running, as we talked about earlier, 5, 6, 7 different calculations when you run it with the standardized versus the alternate. And then you run each of those with the 2 different permissible periods. And ultimately you're trying to figure out what's the best way to maximize that loan forgiveness. And it's probably good to start running those calculations and starting to see what that could look like for you as an organization based on your own ministry model. If you're a school versus a church, if you have a preschooler, if you don't, if you hire summer interns or summer workers for your various ministry programming or church programming, those will all impact your specific calculations. And so there's not a one fits all for any of this.
And churches can go ahead and calculate these at least for the reference period, because that's not going to change.
That's correct.
February 19th to June 30th and one for the first 2 months of the year.
Correct. So if you have those in advance, that will certainly help. So again, here in the example, we assume that the following headcounts or FTE headcounts during the covered period, you ended up with 30.2 FTEs. For the one reference period, you end up with a 29.3 for last year comparison. And then for the other reference period would be this year, you end up at a 31.5. Well, then you look at that and you say, okay, if we look at last year's, then we end up with an amount greater than 1, which converts to a 1, and there's no penalty. But if we use this year's calculation, we're less than 1, and there will be a penalty, if you will, or a reduction in the loan forgiveness amount. So you can see where these fractions make a difference.
So looking at your example here, you've got a little less than 96% in the second alternative. Does that mean that there would be a 4% reduction in the forgiveness amount, or am I jumping ahead?
You're jumping ahead just a little bit, but remind me to answer that question in a few minutes. Because actually that's in the loan application that will solve that. So as part of this, so now you're starting to see the actual calculations that you can start running, but there are still some exceptions to the rules that are coming forward as well. So one of those exceptions that we talk about between both the head count, the salary, and the loan and the wage loan forgiveness are, the bullet points here. When you compare those, you can compare your FTE head count for February 15 of this year to your head count of February 15 this year and April 26. This would apply for if there's significant variances. So for example, if you did a layoff or you furloughed your employees, as long as you restore them by June 30th, then some of these FTE calculations can go away. You're just now proving that you did bring them back on before June 30th. So you can offset that as an exception. Another one, if you don't mind going back to that slide, there's another point there. So if there's a reduction of headcount during the period, you can eliminate that reduction by June 30. Here's where there's still no guidance for preschools, private schools, or again, camping environments where you've got this natural attrition and hiring going on during this critical season that we're talking about of April, May, June timeframe. But we're still, anticipating getting that back information. What's interesting is certainly education is a big part of our society, but many of those involved in education are within the government sector already, which have different rules versus private education. And that's what makes this a little bit more nuanced when it comes to the reimbursement of the loan forgiveness, because this is applying to non-governmental organizations. So to the next slide. So again, the exception, compare the salary and wages for employees on February 15th with their salaries from February 15th and April 26th. If there's a salary and wage reduction during this period, you can eliminate that by restoring those wages by June 30th. So if they're back to full-time, their wages, you can demonstrate supporting documentation that those wages have been restored. You can eliminate that penalty as well, or that reduction in loan forgiveness. We've talked about this consistently, so there's nothing new here, but the application in the form, again, because they've got it, the information, but you'll record if you did indeed get one of these EIDL loans, the economic injury disaster loan, you'll indicate that there, and that will then be subtracted from the loan forgiveness amount and offset those. So that's already accounted for in the application. You don't have to worry about doing that separately. We've talked about a best practice of having a separate bank account for tracking the funds. And again, that's not required. So we want to reiterate that there's no requirement from the SBA or from the loan forgiveness. However, the best practice rules still apply. By having it set up in a separate account, it makes it much easier as you're transferring those dollars. You have the supporting documentation to match those amounts being transferred, so that when you go to fill out your application and the supporting schedules, all the information has already been done as you go, and you're not trying to go back and rebuild the last 8 weeks. You've done it contemporaneously. Plus, if you leave those funds separate in that other account, anything that's left in that account is the amount that may not be forgiven and could either be returned and the cash is there to do so, or you may make the decision, we're going to hang on to that cash strategically at the 1% loan interest rate for future needs that we may incur this fall or winter. So that becomes a strategic decision to be made, and that number would then also reconcile to the amount that would not be forgiven and would remain as a loan. Deferral options. The interest and principal payments are deferred for the first 6 months. The interest accrues, but is forgiven if the principal is also forgiven. What we don't know, what will happen is if a loan is only partially forgiven. After 6 months, will the balance be on the remainder, or will it be on the full amount? And will that be accelerated based on what's left that needs to be paid within a 2-year window, which may actually end up being compressed? And so that's where we start getting some of the technical pieces of what will that loan repayment look like, and will the interest on the loan be based on the unforgiven amount or the full amount? And that is what we're still looking to get definitive guidance on yet. On the next slide, again, what we want to make sure we're paying close attention to is on your payroll documentation, because some of this you'll need to submit, and some of it you'll need to maintain on file for several years. You want to make sure you have your bank statements, your payroll registers from your payroll service company showing the cash compensation that's been paid during this 8-week, 56-day period. They'll want to see 941s for that period. Now, certainly if this happens and it crosses, and it, in theory, it could, you could potentially not be covered in a quarterly 9041 report based on the timing of when your 56 days is up, relative to when the quarter is up and when those quarterlies need to be filed. But it's not unusual to think that many people will have completed their 56 days by the end of June, and those will certainly have be needing to submit their 941s with that as part of this documentation. Income, payroll, and unemployment tax filings with the state authorities. You'll need to make sure you have all that documentation available, and some of it may need to be submitted, but you'll want to make sure you've got that available because you'll need it for your calculations. Payment receipts, canceled checks, account statements, along with invoices supporting your health insurance premiums paid and your retirement plan contributions. And Joe, you raised a question earlier about, is this full amount, or we break down to 56 days? Again, the guidance here is we're recognizing that these payments are paid on a monthly basis to that third party. We'll want to try to gauge as close as we can to the days and the payments based on everybody's be different based on when their loan was funded and how it coordinates with when those invoices get received and are paid. So be on standby for that, and we'll have greater clarity coming for those. But you'll want to have the documentation to support the amounts and the dates that it's due and the periods that it covers. On the next slide, the Fte reduction documentation, there'll be schedules required for this. And so there's some handouts, again, our white paper, there'll be some samples in the application process that show you how to fill this out and how to calculate the FTEs, the documentation, along with the salary and wage reduction documentation. So you'll need the first, for example, on the salary and wage reduction documentation, you'll want to reference Q1 documentation. You want to look at the covered periods, or if you pick the alternate period, they'll want to look at all the supporting documentation on how you arrived at your calculations that will be submitted on Schedule A. On the next slide, again, while we're going through on the FTE reduction safe harbor documentation, you'll need to retain, but you will not be required to submit. But you'll certainly have to have the documentation to run the calculations, and that'll be on your Schedule A, all the average hours, the one that you end up picking, etc. All these 3 bullet points. And then you'll need to keep your documentation and your worksheets for the next several years. And on the next slide, again, if you get into the mortgage interest documentation, you'll need to have the supporting documentation from your mortgage lender that shows the amount of the interest that's being paid for the period that's being paid. And then certainly the principal amount will need to be excluded. And again, most of your mortgage payment documentation, those coupons, many times will actually separate those out for you. So you'll need to have that available, and you will need to submit that with your application. Interesting for your rent documentation, they'll want to see a current lease agreement. That will need to be submitted. And so here's a key piece, again, that's in our documentation. If you're not doing a third-party lease payment or rent payment, it will probably be disallowed. And specifically, Joe, we've had this question several times. We have a daycare at our church, and the daycare pays the church rent, but we're all one organization. Most likely that rent will not be allowable for forgiveness. However, if the daycare is a separate organization with its own EIN and you actually have this lease agreement, then it could be, even though they're affiliated and they're related, the fact that they're a separate organization with a lease agreement, and again, that lease agreement needs to be predated to February 15th, then it can be forgivable. You want to have canceled checks. You want, if you're doing EFTs, ACHs, you want statements from the bank indicating the dates that those payments were made, transferred to pay electronic, payments, automatic payments to those third-party vendors. And then as we move into, again, same with utility payments on the next slide, you'll want to have those invoices. You want to show the payment of those and the dates that it was covered, so that you can document indeed that it was incurred and paid for those periods. And so all this documentation we've been telling you all along is the best practice to have handy, because you will need it. Indeed, it is mandatory as part of that loan forgiveness. And so hopefully you've been doing this, you've been doing the best practices, you've already been retaining in a separate file all this documentation that you can start organizing. And even now, we would encourage you to download the application, start looking at those schedules, and start filling in the details as you go, so that when your 56 days are up, you have already filled out the application contemporaneously, and you already have your supporting documentation in the file to ensure that you maximize that loan forgiveness to the benefit of your church, your ministry, and as a great stewardship practice.